Is cash still king in Singapore? If you're sitting on a pile of cash in your DBS or OCBC savings account thinking you're playing it safe, I've got some uncomfortable news for you. While you're sleeping soundly at night, inflation is quietly pickpocketing your wealth. Here's the kicker. Even conservative investment strategies can crush cash returns without adding much risk. Today, we're diving into why holding too much cash might be your biggest financial mistake as a Singaporean investor. We'll explore when cash makes sense, when it becomes dead weight, and most importantly, how to put your idle Singapore dollars to work without losing sleep. Want to access premium content before they are made available? For just $1 a month, you can become a premium member and unlock a wealth of additional content, including daily market analysis, early insights into promising trends, deeper dives into specific investment strategies, analysis, and perspectives that will give you a real edge in growing your wealth. Think of it as your daily dose of financial fuel. Just click on the membership tab to join. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 950,000 reads and 57,000 likes. I've produced over 800 videos with more than 380,000 watch hours as of May 2025. I also focus on regional and global economic trends. Let's start with the harsh reality for Singaporeans. Cash feels safe, right? It's like keeping your money in your POSB savings account. You know exactly where it is. But here's what's really happening. Singapore's inflation rate has dropped to just 0.9% as of March 2025, hitting a 4-year low. Meanwhile, your typical savings account gives you maybe 0.05% interest. Even with low inflation, your money isn't growing in real terms. Picture this scenario that many Singaporeans face. You have 500,000 Singapore dollars sitting in cash, earning 2.5% interest from a high-yield savings account like DBS Multiplier at its maximum rate. Sounds decent? Not really. Over 5 years, even conservative investment strategies can leave cash in the dust. We're talking about performance gaps that could mean the difference between affording that HDB upgrade or staying put. Why is this happening now? The Monetary Authority of Singapore has been easing monetary policy. In January 2025, MAS made its first policy easing since 2020. Interest rates are heading down. Your savings account rates? They're following this trend. UOB1 account just slashed rates from 4.0% to 3.3% effective May 2025. OCBC 360 also reduced their rates. This creates a challenging environment for cash holders. Think about it this way. Even with inflation at historic lows, your cash still needs to work harder to maintain purchasing power over time. But wait, doesn't cash provide security? Absolutely. Cash serves important purposes for Singaporeans. It's your buffer against uncertainty. Need to pay for medical expenses not covered by MediSave? Cash helps. Want to deploy capital quickly during market dips to buy Singapore REITs or STI ETF? Cash gives you that flexibility. The problem isn't having cash. The problem is having too much cash doing nothing while opportunities pass you by. So how do we fix this? Think of cash as part of your portfolio strategy, not separate from it. Let's break this down into functional buckets that make sense for Singaporean investors. First bucket, emergency cash. This is your financial fire extinguisher. Job retrenchment, medical emergencies, or unexpected family expenses. This cash handles life's curveballs. Financial experts recommend 6 to 12 months of expenses. Keep this highly liquid in Singapore dollar deposits. Consider high-yield savings accounts like DBS Multiplier at up to 4.1%, UOB1 at 3.3%, or OCBC 360. You could also park some in Singapore savings bonds currently offering 2.56% average return over 10 years, or short-term fixed deposits offering up to 2.45%. Second bucket, defensive assets. These preserve capital while providing stability. Think Singapore government bonds, dividend-paying Singapore stocks like DBS, OCBC, or Singtel, or defensive sector ETFs. The SPDR Straits Times Index ETF is a solid option. It delivered 23.5% total returns in 2024, marking its best performance in over a decade. Singapore REITs, like CapitaLand Integrated Commercial Trust or Maple Tree Logistics Trust, also fit here. The Lion Phillip S REIT ETF offers 5.8% dividend yield and provides diversified exposure to quality Singapore REITs. Third bucket, growth strategies. After securing your foundation, excess cash can chase longer-term gains. This is where you diversify beyond Singapore. Consider U.S. markets through brokerages like Tiger Brokers or Interactive Brokers. The Invesco QQQ Trust ETF tracks the NASDAQ 100, though it declined 8.11% in Q1 2025. For clean energy exposure, the iShares Global Clean Energy ETF is available, though it has faced volatility. Add some commodities exposure through gold ETFs for extra diversification. Worried about timing? Use dollar cost averaging through regular savings plans offered by most Singapore brokerages. It's like slowly wading into a pool instead of jumping in. You stay partially invested while building conviction. Many Singaporeans use this strategy to invest in STI ETF or global funds monthly. Fourth bucket, income-generating hybrids. Perfect for retirement planning or income-focused portfolios. Multi-asset income funds from fund houses like Nikko AM offer diversified exposure. The Nikko AM Global Multi-Asset Income Fund delivered 8.81% returns in the past year. Singapore REITs combine yield with growth potential. Consider the Lion Phillip S REIT ETF for broader exposure to quality Singapore REITs. Here's the key insight for Singaporean investors. Not every dollar needs aggressive investing, but idle cash beyond immediate needs should work harder. Your CPF already provides a conservative foundation with 2.5% on ordinary account and 4% on special, MediSave, and retirement accounts. Your cash above CPF contributions should work harder. The math is compelling for Singaporeans. The STI delivered 23.5% total returns in 2024. Singapore REITs are positioned for recovery in 2025 as interest costs stabilize. Even conservative bond portfolios can beat basic cash returns. This performance difference compounds over time. For young Singaporeans starting their careers, this is especially crucial. Consider supplementary retirement schemes like SRS, which offer tax benefits while investing in approved funds. Different life stages require different strategies. Fresh graduates might focus more on growth through global ETFs. Mid-career professionals might balance between Singapore blue chips and international exposure. Pre-retirees might emphasize Singapore REITs and bonds for income. The regulatory environment in Singapore supports smart investing. Our financial system is robust. MAS regulations protect retail investors. You have access to world-class brokerages and fund platforms. There's no excuse for letting money sit idle. Let's wrap this up. Cash has a role in your Singapore portfolio, but it's not a strategy. Once you've secured your financial foundations, emergency buffer, adequate insurance coverage, align your remaining cash with investment goals. You don't need to go all in on risky investments, but staying completely out might cost more than you realize. In today's environment of falling interest rates and persistent low inflation, smart cash deployment is one of the most underappreciated wealth drivers for Singaporeans. The bottom line, stop letting your money sit idle when it could be working for you. Put your Singapore dollars to work intelligently across different buckets based on your goals and timeline. Your future self will thank you when you're sipping kopi at a hawker center, knowing your money worked as hard as you did. If you found this video helpful, smash that like button and subscribe for more wealth-building insights tailored for Singaporeans. Drop a comment below. Are you holding too much cash? What's your biggest concern about investing in Singapore? So, if you found this video helpful and want to level up your investing game with daily premium insights for just $1 a month, click the link in the description below to become a member. You won't regret having that consistent stream of valuable information that can help you on your financial journey. Next up, check out my video on why ignoring diversification could cost you in the future. It perfectly complements today's discussion on smart money allocation for Singapore investors.